Property values across major Australian hubs like Brisbane and the Gold Coast have experienced a significant surge in recent years. For the average homeowner in standard suburbia, these market gains represent massive, unrealized paper wealth. This wealth remains theoretical until the bank sends a notification. They frame untapped equity as a financial reward available for immediate use. The sudden accessibility of hundreds of thousands of dollars creates a rush of wealth without any new labor. This psychological win often masks the underlying mechanics, as many homeowners treat a credit offer as personal savings. This available equity serves as a marketing catalyst to reset the interest cycle for another 30 years. Accessing equity generates a brand new, heavy debt obligation, strictly pinned against the hope of future property price growth. The bank quietly restarts the 30-year mortgage clock the moment that equity is drawn. This chart tracks a new car's rapid value loss funded by home equity. Financing a depreciating asset creates a severe mathematical mismatch over 30 years of compounding interest. The final cost reaches several times the original price for an asset that loses all utility. Relying on equity for consumption leads to decades of additional work to pay for items that no longer exist. The risks escalate when homeowners use equity from their primary residence as a deposit for an investment property. This often triggers cross-collateralization, a clause that legally binds the family home and the investment into one entangled debt structure. If the investment property loses value or fails to generate income, the bank has the authority to seize the family home to cover the loss. External triggers, such as consecutive interest rate hikes by the central bank, can rapidly make these dual repayments unsustainable. This leads to negative equity, where the total debt owed to the bank exceeds the market value of both properties combined. The borrower has effectively placed their family home into a legal framework that prioritizes the bank's security over their own. Successful investors treat property debt as a high-voltage industrial tool rather than just a source of personal consumption. They use released equity exclusively for assets that generate income, ensuring the debt pays for itself. This strategy requires loan segregation, ensuring the mortgage on the family home is kept strictly separated from any investment liabilities. This structural firewall ensures that a market downturn on the investment side cannot jeopardize the primary residence. They then use debt recycling, applying investment income to systematically reduce the non-deductible debt on the home. Taking control of your loan structure prevents the bank from dictating the long-term math of your financial future. Equity release can build generational wealth or destroy it. The outcome depends on who controls the underlying mathematics of the contract.